If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
Hello everybody, it's Tortoise Investing coming at you today with 5 best dividend stocks to buy now. I have been looking through 20, 30 of them at this point, and these are the 5 that really pop out at me that are off of some of their recent highs, that have strong financial sheets, and a good history of growth. Now, as always, none of this financial advice. Always do your own research before buying anything. Make sure you hit that subscribe button if you haven't. Hit the like button and comment down below what's a stock that you've been looking at or buying here recently. I would like to hear from you. Let's blow those comments up. But without further ado, we're going to be taking a look at PepsiCo, Texas Instruments, Dairy and Restaurants, probably said that wrong, T. Rowe Price, and Realty Income. Now, Pepsi is off a recent high of around $195 down to $178. This is a very strong defensive company. It's got an adjusted free cash flow yield of 2.18%, has a dividend yield of 2.74%. Payout ratio a little bit high, but this company has raised its dividend for over 50 years. They know what they're doing. Now let's take a look at the revenue. Revenue has been increasing at a rate of 6.3% over the last 5 years. Very nice. The free cash flow, it's negative for the 5 year. It has been hovering around this 5 billion area since 2010. It went up and then down and up and then down, but never really dipping below 5 billion. So they always keep a good bit of cash on hand. I'm not going to complain about that. That is still some really nice free cash flow. EPS been increasing at a rate of 13.69% over the last 5 years. Very nice. Their debt, they have $35 billion in debt. Their EBITDA is $14 billion. My rule of thumb, if you've seen my stuff before, I do not like companies that have more than 3 times their EBITDA in debt. Simple little bit of math there, but it's just a way to make sure they have a strong financial sheet, or at least that's the metric that I go by. Again, not financial advice. It's just what I personally do. Dividend's been increasing at a rate of 8.34% over the last 10 years. Their last hike was 10%, so that's very nice. That's some great compounding going on there. Shares outstanding have been decreasing at a rate of 1.27% over the last 10 years, but here lately they've not been buying back all that many, which is okay. Return on capital employed as of 2022 is 17.6% and off its low in 2020 of 14.49%, so a very nice return on capital employed as well. Next up, Texas Instruments. This one's one that I've got my eye on. I feel it is at a pretty good price from where it has been over the last year. It's not really had that many dip opportunities. Adjusted free cash flow yield of 1.91%, dividend yield of 3.01%, and a payout ratio of 58.46%. So not too bad there. It is off its recent high of, let's see if I can find it here, $186. So it's down $23 off its recent high, down to $163. The revenue's been increasing at a rate of 6% over the last 5 years. Very nice. Free cash flow increasing at a rate of 7.33% over the last 10 years. It's kind of mellowed out here recently, 4.88% over the last 5. The EPS, this is very nice. EPS been growing at a rate of 20% over the last 10 years, 20.9% over the last 5 years. This is accelerated growth in their EPS, and I love that. It's great. And the really big green check mark of this company is they have more cash than debt on hand. That is something you do not find every day. That is a very, very rare thing to see in companies now. Usually a lot of them carry some debt of some sort, and it's usually more than their cash. So when a company has more cash and debt on hand, that is the biggest green check mark in the world. Dividend's been increasing at a rate of 16% over the last 10 years, 14.87 over the last 5 years. Very nice. Again, Some great compounding going on there. Shares outstanding have been decreasing at a rate of 2% annually since the last 10 years. Very nice. And the return on capital employed is just ridiculous. 34.75% in 2020, 41.86% in 2022. So that is growing along with everything else. Texas Instruments, I really like them. Next up, Daring Restaurant. Off a recent high of 172 down to 149. It's got adjusted free cash flow yield of 4.85%. It's got a dividend yield of 3.5% and a payout ratio of 60.5%. So again, checks are all around there. No issue whatsoever. The revenue's been increasing at a rate of 5.35% over the last 5 years. They have had some accelerated growth as of late. From 2020 to 2021, these were some rough years. But here in the last 2 years, 20.72% growth in their revenue. Very, very nice. The free cash flow has been increasing at a rate of 13.7% over the last 10 years, 10% over the last 5 years. Very nice, just slow and steady up and to the right. The EPS been growing at a rate of 11% over the last 5 years, right at 10% over the last 10 years. Again, very nice. Everything in the world almost has a 2020 hiccup. Their debt is very low at $884 million. Their EBITDA is $1.57 billion, so there is no issue there whatsoever. They do have some cash on hand as well. The dividend, they did cut their dividend during 2020, so a lot of companies did that, but they increased it right back up to where it previously was and just been off to the races, increasing that dividend at a rate of 11.8% over the last 5 years and at a rate of 10.3% over the last 10 years. So again, some nice little compounding going on. This is a company that isn't afraid to pause or decrease it if need be, but it's not something that happens a lot. The shares outstanding have been going down at a rate of 3% over the last 2 years, 4.7% over the last 1 year. So it was at 131.8 million shares outstanding in 2021, and now they're sitting at 122. So that is about 9 million shares bought back over 2 years. Not too bad. Return on capital employed in 2020 is 10.16, 2021 7.37, and 14% in 2022 and 14.47% so far in 2023, and the year's not over yet, so it's going to be even higher. I like Daring Restaurant. If you don't know, they are the ones that are over Olive Garden brand, Longhorn Steakhouse, Cheddar's. I know some of those names probably ring a bell for you. But yeah, I love Olive Garden. I'm a big fan of that. Next up, T. Rowe Price. T. Rowe Price off of a very recent high of, as about 126, I believe. Yep, 126 down to 110, so it's down about $16 off of its recent high. It's got adjusted free cash flow yield of 4.1%. It's got a dividend yield of 4.47% and a payout ratio of 72%. A little bit high, but not an issue when it comes to T. Rowe, and you're about to see why. It's very, very similar thing that Texas Instrument has. So revenue's been increasing at 7.94% over the last 10 years. Very nice. The free cash flow, 9.89% increase over the last 10 years. EPS 7.15% over the last 10 years. They were growing very rapidly, and then in 2022, things kind of slowed down a lot. A lot of people started withdrawing their funds and having to use their money for other things because inflation's being absolutely wonky right now. But it's T. Rowe Price. They've been around for a while. They've been increasing their dividend forever, and they have no debt. They don't carry any debt, something that this company typically doesn't do. They have $1.76 billion in cash, so that's the big reason why I'm not afraid of this being in the 70s for their payout ratio. They got so much cash on hand, they're able to take out debt if they need to. I don't think they'll need to, though, but yeah, I like it a lot. The dividend's been increasing at a rate of 12.37% over the last 10 years. Their last hike wasn't all that big. Again, they've been having a little bit of issues. It was only 2 cents, but I think it's going to get right back on track with things starting next year with them. Again, not a guarantee, just I see T. Rowe Price having a bright future. Over the last 10 years, shares outstanding been decreasing at a rate of 1.38%. It's slowly, it's kind of all over the place, kind of like a wave, but it is trending downward. And the return on capital employed, 2019 was 18.3%, 2020 was 19.8%, and as of 2022, 21.21%. So this is slowly creeping up again. Very nice company. I like it a lot. And next up, a lot of people's favorites. We got Realty Income off of a recent high of, what we got here, 68 down to 55. If you want to take this out to a year, they were at one point, let's see here, were they higher than that? Yeah, back in back before they had the dip in 2020, they were at $81 a share, and then COVID happened, and then they were just kind of up and down, 70s, 74, 74 again. So it looks like they were hitting 74 and bounced off of a resistance there. They've not been able to get back up to that level, but a big thing that's been hurting this company, as well as been hurting a lot of REITs, is the interest rates have just been going up, and no end in sight, it seems. Except I don't really see them doing any more hikes. I am super bullish on all realty, like REITs. I feel like they've got a great future ahead of them, and I feel like a lot of them are beaten up because they usually have to carry a lot of debt. Interest rates are really high. That hurts a lot of REITs. And Realty Income with a dividend yield above 5% and above 5.5% is just ridiculous to me. And if you're new to REITs are taxed differently, and the payout ratio, 224%, you might be thinking, what? Well, they are, the way you look at their payout ratio is funds from operations. You don't look at it from an EPS point of view. But we'll still take a look at free cash flow and the revenue. Revenue's been increasing at a rate of 21.5% over the last 10 years. Very nice. And the free cash flow increasing at a rate of 22.8% over the last 10 years. So this company is just trucking right along, growing like crazy. They just made a recent acquisition of, I think, a gaming facility, like gambling. So they are being even more diversified. And I think I read like their occupancy rate right now is like 99%. So very high. The dividend's been increasing at a rate of 3.8% over the last 10 years. This is just slow and steady. I think they increase it a little bit every quarter, like half a cent, if that. And then they do a bigger hike once a year. But yeah, those are 5 strong dividend companies. I like all of these a lot. As always, do your own research and stuff before buying. Don't buy it just because I said it or showed it in this video. But yeah, until next time, I hope everyone takes care. See yous.